Well, howdy there folks, and welcome into today's video. Hope you guys are doing great out there as always. So today we're going to talk about 3 new growth stocks I never talk about on the channel that are down over 50%. I saw this basically article in the newsletter yesterday on the Hungry Bowl that they put out on 3 growth stocks that have crashed over 50%, and is it time to buy these stocks? So I said, let's go ahead and let's do a little reaction to these 3 stocks in this video here today. Let's talk about these stocks, not stocks I ever talk about on the channel. So I want to give my 2 cents on these stocks. Do I think they're buys? Do I not think they're buys? Things like that. So I hope you guys enjoy this video as always. All I ask in return is that you smash that like button, and that's literally it. I appreciate you guys in a huge way for being here. By the way, if you haven't got a chance to check out the Hungry Bowl, that is a way to track your stocks, keep up with the news in relation to your stocks, as well as do a little bit of research, listen to earnings calls. I'm hoping to have SEC reports in there in the next week or 2, as well as read our daily newsletter. So if you haven't got to check that out on your iOS or Android store, definitely do it. It's absolutely free to use that, all right? Well, you know, I got to at least mention, the chef is up, guys. I couldn't believe it. I woke up this morning and I was like, oh my gosh, the chef is actually up. I got to turn my fireplace green. Oh, it's magical. And oh man, obviously the short sellers and the bears, they've had a lot of fun over the past, few trading days, let's put it that way, with the memes, making fun of me, making fun of it, anybody in the Tattoo Chef squad. But I gotta say, I definitely saw the longs getting back at him today. I like this one. Burr, that's one of the bearish people on the stock, when he knows Jeremy makes 10,000 plus for every 1% it goes up. Oh man, yeah, if you're gonna give it, you got to be able to take it as well, man. And the bears and the short sellers, they love to make all those memes when the stock's going down, but hey, it happens the other way as well. Alrighty guys, let's get into these 3 stocks. First one up here of the bunch is this one. It's a Wish, and the Wish shareholders wish I would say a lot of good things about this one, okay? The Wish stock. This one has been getting devastated. Look at this, okay? The discount e-commerce platform is down about 70% since its NASDAQ debut in December, booking a 26% loss in the past 3 days alone. The company posted disappointing earnings last week, reporting a 13% drop in downloads and a 15% decline in average time spent on the app from the prior quarter. Okay, so first off, that's like legit bad news, okay? This isn't like a situation where it's like, oh, they just barely missed analyst estimates on the revenue or something like that, right? Like, oh, they missed by $4 million in revenue. No, this is different, okay? This is really bad news. When you report a 13% drop in downloads and a 15% decline in average time spent on app from the prior quarter, that means people are spending far less time on your app, and that means a lot less people are interested in downloading. So, which is obviously bad news for Wish or any app, like, in general, right? Revenue fell 29% year over year. Also, super bad news. I mean, as an e-commerce company, it doesn't matter. You should never see your revenues decline, right? Never. And the fact that this company had 29% year-over-year revenue down is extremely bad news. I can understand why the stock has gotten absolutely devastated. Many Wall Street analysts have downgraded the stock, but 64% of analysts have Wish as a buy. That's kind of scary when you see these type of bad numbers, and 64% still have it as a buy. That means there's probably more analysts coming out to go to holds or sells, right? With rest saying hold. The depressing quarterly numbers were likely amplified by the broader trend of slipping e-commerce sales as the economy reopened during the quarter, and Wish is making an intense effort to improve operations and product with recent hires from Google, okay? I understand, like, the world's opening back up. Maybe e-commerce sales aren't as strong as expected, but you can't have 29% down year over year. You can't have 13% drop in downloads, and you can't have 15% less time spent on the app, right? That's just things you can't have. And not only that, when it comes to this Wish stock, it gets worse, okay? You're looking at it, by the way, look at that chart. Oh my goodness, from 22 to $6 here today, right? You're looking at a company that roughly has, let's say, a $4 billion market cap on it or so, or a little over $4 billion. But here's the problem with Wish. This is a company that is going to shrink revenues this year, right? Expected to be down 1%, but when you saw 29% down last quarter, don't be surprised if that number is a lot worse than that. Expected to get back to revenue growth next year, but that's not when you just see a year-over-year number down 29%. Don't automatically expect they're going to grow, right? But let's assume they grow. It's still very low growth, and the company is a money loser. Okay. So at the end of the day, when it comes to Wish, as bad as, you know me, I love beating down dog stocks. And this one's, woo-wee, it's definitely a beaten down dog stock from $22 to $6. I mean, I would love to be like, yeah, this is the next stock I'm buying. But man, I mean, there's nothing to be excited about here. When you have 29% revenue growth down year over year, when your downloads are going down, when people are spending far less time on your app, and you're a money loser, all those are wrapped into one. It's too much bad news to overcome for me to be like, I gotta go buy this one as bad as I would like to. If I saw a major change in the business model, I don't even need to see a major change in the business model. I just need to see enough change that would make me say, okay, this is interesting. Okay, then we can talk. But right now, it's in an ugly, ugly place, and somebody needs to save that company because they're in a bad situation. Let's put it that way. Okay, so that's Wish stock. That was the first of these three stocks up mentioned here. Let's get in the second stock of these three, and that is this one, Fastly, FSLY. Now, before I get into this, real quick, for the Hungry Bull app, we actually just started using Fastly recently. The tech team, Ryan over there and whatnot, he says, Fastly definitely helps us basically with our speeds as far as opening the app and things like that in different markets in a major way. So I just want to tell you guys that literally for the Hungry Bull, we're using them now. Fastly's valuation has been cut in half over the past 6 months. Its latest earnings report revealed a slow in yearly growth, and Fastly expects revenue to only grow 17 to 20% for the full year, versus previous analyst estimates at 31%. That's a massive change in growth rates, right? We're only going to grow 17 to 20% when you were supposed to grow 31%. Once again, another stock that I can understand has been devastated, right? The stock has been getting hammered as a service outage in June led to some big customers. Let's hope they never have a service outage anymore, man. I don't want that for the Hungry Bull. Led some big customers away from the cloud computing platform, but customer accounts are still up 30% year over year. Bulls say Fastly has a unique opportunity to expand revenues through the edge computing servers and deliver higher margins in the future. 64% of analysts have Fastly as a hold. It's interesting from that perspective. That's exactly what we're using it for, the edge, right? And I can definitely see this being a potential sticky business model long term where clients such as, us with the Hungry Bull, right? Or other apps that get used to using them, as long as we're happy with them, right? We're going to continue to use them and they'll have pricing power long term. However, they got to watch out because I could tell you, if all of a sudden an app goes down for a day or several days, your clients are going to be off of you, right? They're going to go to some other competitor or somebody like that, right? And from my understanding, as far as Hungry Bull, like Fastly made the most sense for us when trying to choose somebody for the edge because of the kind of their customized solutions they can have over there, okay? But this is the bad news, okay? If they ever have that type of situation again with Fastly, I can tell you they're going to lose more clients and they'll be just kind of cast away as unreliable. So they really need to watch that. So it's definitely a risk, okay? Now, another kind of troubling thing with Fastly is when you look at this stock, we're talking about, by the way, I don't know why Yahoo's finance is tripping. There's no forward P on the stock. They're expected to lose money next year as well. So it's a money-losing company, and it's at a price-to-sales ratio of, let's say, 14. Definitely, even after all that falling in the stock, is definitely pretty highly valued still on a price-to-sales ratio and the fact that they don't make any money. Now, on the flip side, what excites me about Fastly, when I really think about this one, is I can definitely see them growing at, let's say, a 15 to 25% clip for years and years and years and years to go in the future, as long as they have no more major outages. That's the big thing, okay? If they have another major outage, oh boy, okay, it could get much uglier for the stock. But as long as they can stay out of outages, I could see the stock being a 15 to 25% revenue growth company for years, like as far as I can see pretty much. And from that perspective, it makes it pretty interesting. And then when you think about margins long term, as this company gets more and more clients and into the sticky business model, which is a needs-based business model, the edge, right? I can definitely see Fastly as being one of those stocks that could potentially be a beast long term. So I'm at least interested in this one. I'm going to do more research here. It's interesting to me, okay? Fastly. All right, guys, let's get in this last stock, the third stock of these three. And by the way, a lot of you guys might own the stock or have thought about owning the stock in the past. I don't think I've ever talked about this one, although it's kind of a EV-related play, okay? And it is Plug Power. Plug. After a wild run in the back half of 2020, Plug Power dropped off significantly from its all-time highs. The stock is down 48.5% over the last 6 months, but has rebounded off recent lows to $20 per share. Oppenheimer analyst Colin Roush reiterated his buy rating on Plug with a price target of $62, representing a potential upside of nearly 150%. 150%. The hydrogen fuel cell company recently started working on its third green hydrogen plant, and Roush says this offers Plug with critical scale capabilities. Plug Power also recently raised revenue guidance to a range of 475 mil to 500 mil, okay? Like I said, this stock is one of those that, you know, it kind of gets, let's just say it's obviously wrapped up into, I don't want to call it the EV wave. I really want to call it the, let's call it the renewable energy wave, right? And with all the renewable energy stocks made this crazy move in the back half of 2020, and obviously at the beginning of 2021, Plug Power went right along with all those other renewable energy type companies, right? And so if we look at this company, look at this. It was at $75+ and it's at $25. The fall has been dramatic. It's still a pretty big market cap on this company, right? $14.5 billion. So, I mean, we're not talking about one of these small caps like a lot of these stocks that have been, you know, heavily damaged. This is actually a pretty big market cap, $14.5 billion there on Plug Power, right? Now, I will say what is interesting about this stock, okay? What is not interesting is the money loser, right? Expect to lose money this year and next year as well. But where things are a little bit at least interesting when it comes to Plug Power, and why I might have to spend a little time on this stock, is look at the revenue growth expected here. 45.5% revenue growth expected in current year, and then an acceleration of revenue growth, which, you know, one of the best things you can ever see in a stock is revenue acceleration. 51.6% revenue growth expected in 2022. And so that makes this stock actually pretty darn intriguing, okay? So Wish stock, you know, I got to see something change in the business model. Fastly, definitely the most interesting of these three for me. And this one's a little interesting, the Plug Power as well. Hope you guys enjoyed this video. As always, much love and have a great day.